to Girl Investors. This channel is dedicated to teaching you about investing and money. Financial intermediaries such as commercial, mortgage, and investment banks, credit unions, credit card companies, and various other finance corporations, brokers and exchanges, dealers and arbitrageurs, clearinghouses and depositories, mutual funds and hedge funds, and insurance companies. All of these help entities efficiently achieve their financial goals. And did you know that financial intermediaries are essential to a well-functioning financial system? Financial intermediaries help connect buyers to sellers in various ways. They stand between one or more buyers and one or more sellers and help them transfer capital, which is money, and risk between them. Financial intermediaries' activities allow buyers and sellers to benefit from trading, often without any knowledge of the other. So if you're going to be investing in the securities markets, a broad understanding of the different types of financial intermediaries is essential. So that's what we'll teach you in this video. So by the end of this video, you will know what the main types of financial intermediaries are that provide services and products in well-developed financial markets. So if this interests you, then please keep watching. Brokers and exchanges. Brokers are agents that help buyers locate sellers and vice versa, and arranges the sale. A broker may also help buyers and sellers agree on a price. So some brokers match clients to clients personally, and others will use specialized computer systems to identify potential trades and help their clients fill their orders. Brokers also help their clients trade by reducing the cost of finding counterparties for their trades. So importantly, they do not trade with their clients. But in general, buyers and sellers often pay a fee or a commission to the broker for these services. So for example, one broker that I use to trade is called Interactive Brokers, and they charge $4.95 a trade at the moment. So there are many new brokerages that advertise commission-free stock trading, but I would advise you to be careful and to read the fine print to see what that really means. So the idea of a broker of stocks is very similar to that of a realtor for houses. So a realtor helps bring buyers and sellers of homes and other properties together and facilitates the sale, and then they collect commission for their services. So that being said, if you want to invest in individual stocks, you will need to set up an account with a broker. And examples of Canadian brokers for trading stocks include Questrade, Qtrade Investor, Interactive Brokers, TD Direct Investing, and CIBC Investors Edge. And examples of U.S. brokers include TD Ameritrade, Fidelity, Charles Schwab, E-Trade, Interactive Brokers, and Merrill Edge. Investment banks provide advice to their mostly corporate clients, and they help them arrange transactions such as initial and seasoned securities offerings, which are also known as IPOs or initial public offerings. And their corporate finance divisions helps corporations finance their business by issuing securities such as common and preferred shares, notes, and bonds. And so if you're not sure what any of those are, perhaps you'd like to see our last video on what stocks are for more information, and I'll provide a link in the description box below. Another function of corporate finance division is to help companies identify and acquire other companies, such as mergers and acquisitions. Exchanges. Exchanges provide places where traders can meet to arrange their trades. Historically, brokers and dealers met on an exchange floor to negotiate trades. However, more and more exchanges even arrange trades for traders based on orders that brokers and dealers submit to them. And these exchanges essentially act as brokers. For this reason, the distinction between exchanges and brokers has become quite muddied. Exchanges and brokers that use electronic order matching systems to arrange trades amongst their clients are functionally indistinguishable in this respect. So examples of exchanges, which I'm sure you've heard of, include the New York Stock Exchange, the NASDAQ, the Toronto Stock Exchange or the TSX, the Deutsche Börse from Germany, the Chicago Mercantile Exchange, the Tokyo Stock Exchange, the Shanghai Stock Exchange, or the National Stock Exchange of India. I hope you get what I'm trying to say. There's many stock exchanges around the world. So exchanges are essentially distinguished from brokers by their regulatory operations. So most exchanges regulate their members' behavior when trading on the exchange and sometimes away from the exchange. So this means that they require timely financial disclosure. So their regulatory authority comes from their national or regional governments or through the voluntary agreements of their members and issuers to subject themselves to the exchange regulations. And most countries also impose financial disclosure standards on public issuers. Examples of government regulatory bodies include the Japanese Financial Service Agencies, the Hong Kong Securities and Futures Commission, the British Financial Services Authority, the U.S. Securities and Exchange Commission, which is the U.S. SEC, and the Ontario Securities Commission. And there's many others, but I have not listed them all here. Dealers fill their clients by trading with them. Notice the contrast with brokers. The service that dealers provide is liquidity. When their clients want to sell securities or contracts, dealers buy the instruments for their own accounts. So if their clients wants to buy securities, dealers sell securities that they own themselves or that they have borrowed. So after completing a transaction, dealers hope to reverse the transaction by trading with another client on the other side of the market. And when they are successful, they effectively connect a buyer who arrived at one point in time with a seller who arrived at another point in time. And dealers tend to be situated within proprietary trading houses, investment banks, and hedge funds, or as sole proprietorships. So examples of companies with large dealing operations include Deutsche Securities, which is from Germany, RBC Capital Markets, which is in Canada, Nomura, which is in Japan, Timberhill from the United States, Knight Securities from the United States, and Goldman Sachs as well from the United States, and the IG Group from the United Kingdom. Securitizers. Securitizers and investment companies sometimes create new financial products when they buy and repackage securities or other assets. For example, mortgage banks commonly originate hundreds or thousands of residential mortgages by lending money to homeowners. You might even have a mortgage yourself. And the banks then place these mortgages in a pool and sell shares of the pool to investors as a mortgage pass-through securities, which are known as mortgage-backed securities. All payments of principal and interest are passed through to the investors each month after deducting the cost of servicing the mortgages. And investors who purchase these mortgage-backed securities obtain securities that in aggregate have the same net cash flows and associated risk as the pool of mortgages. So in a nutshell, the process of buying assets, placing them in a pool, and then selling securities that represent ownership of the pool is called securitization. And you might find it interesting to learn that mortgage-backed securities have the advantage that default losses and early repayments are much more predictable for a diversified portfolio of mortgages than they are for individual mortgages. And they're also attractive to investors who cannot efficiently service mortgages but wish to invest in mortgages. And by securitizing mortgages or the mortgage pools, the mortgage banks allow investors who are not large enough to buy hundreds of mortgages to obtain the benefits of diversification and economies of scale in loan servicing. Depository institutions and other financial corporations. Depository institutions include commercial banks, savings and loan banks, credit unions, and similar institutions that raise funds from depositors, from people like you and me, and other investors and lend it to borrowers. The banks give their depositors interest and transaction services such as check writing and check cashing in exchange for using their money. So they may also raise funds by selling bonds or equity in the bank. So these banks are financial intermediaries because they transfer funds from their depositors and investors to their borrowers. The depositors and investors benefit because they obtain a return, which could be interest or transaction services, dividends, or capital appreciation on their funds without having to contract with the borrowers and manage their loans. So the borrowers benefit because they obtain the funds that they need without having to search for investors who will trust them to repay their loans. So it's practically a win-win. Insurance companies. Insurance companies help people and companies offset risks that concern them. So they do this by creating insurance contracts, also known as policies, that provide a payment in the event that some loss occurs. The insured buy these contracts to hedge, which means to protect against potential losses. And common examples of insurance contracts, which I'm sure you've heard of, include insurance for cars, fire, life insurance, liability insurance, medical, theft, travel, and even disaster insurance contracts, such as for earthquakes. Insurance contracts essentially transfer risk from those who buy the contracts to those who sell them. So although insurance companies occasionally broker trades between the insured and the insurers, they more commonly provide the insurance themselves. So in that case, the insurance company's owners and creditors become the direct insurers of the risk that the insurance company assumes. Even insurance companies can transfer risks that they do not wish to bear by buying reinsurance policies from reinsurers. And perhaps you already noticed, insurers are financial intermediaries because they connect the buyers of their insurance contracts with investors, creditors, and reinsurers who are willing to bear the insured risks. The buyers benefit because they can easily obtain the risk transfers that they seek without searching for entities that would be willing to assume those risks. And the last two financial intermediaries in this video I will only cover very briefly. Arbitrageurs. Arbitrageurs trade when they can identify opportunities to buy and sell identical or essentially similar instruments at different prices in different markets. So they profit when they can buy in one market for less than they sell in another market. And arbitrageurs are financial intermediaries because they connect buyers in one market to sellers in another market. So they provide liquidity to the markets because they make it easier for buyers and sellers to trade when and where they want to trade. So interestingly, because dealers and arbitrageurs both provide liquidity to other traders, they actually compete with each other. The dealers connect buyers and sellers who arrive in the same market at different times, whereas arbitrageurs connect buyers and sellers who arrive at the same time in different markets. So in practice, traders who profit from offering liquidity rarely are purely traders or purely arbitrageurs. So instead, most traders attempt to identify and exploit every opportunity they can to manage their inventories profitably. And the last one, finally, is settlement services. Financial intermediaries also help their customers settle their trades and ensure that the resulting positions are not stolen or pledged more than once as collateral. Financial markets work best when strangers can contract with each other without worrying whether their counterparts are able and willing to honor their contract. So clearinghouses, variation margins, maintenance margins, and settlement guarantees made by creditworthy brokers on behalf of their clients help manage credit risk, and ultimately they allow strangers to contract with each other. So there you have it. Now you have learned about financial intermediaries that connect buyers to sellers. Be sure to check out our channel to watch other videos that we've posted. And if you've learned something, please click the like button and subscribe if you'd like to see more of this type of content. Thank you so much for watching, and hopefully we'll see you in our next video.